Before we start, remember, this is not financial advice. Always do your own research and consult a professional. If you find this helpful, please like and subscribe for more content. Alright, so let's get right into it. What if I told you the stocks you already own, the ones just sitting in your brokerage account, could be making you extra money? I'm serious. I'm talking about a consistent passive income stream that you can generate on top of any dividends you might be getting and on top of any appreciation in the stock's price. It sounds almost too good to be true, like some kind of financial wizardry, but I promise you it's not. This is a real strategy that thousands of investors, from beginners to the pros on Wall Street, use every single day to squeeze a little more juice out of their investments. It's like owning a rental property, but instead of tenants, you have your stocks paying you rent. Now, before you click away thinking this is some complicated scheme that requires a PhD in finance, let me stop you right there. This is surprisingly simple. We're not talking about day trading or trying to time the market perfectly. In fact, this strategy works best with stocks you plan on holding for the long term anyway. Think about it. Your stocks are just assets. They're valuable. And just like you can rent out a spare room in your house on Airbnb for some extra cash, you can essentially rent out your stocks to other people in the market for a fee. This fee, which we call a premium, goes directly into your pocket. Instantly. For free. The beauty of this is that you get paid up front. The moment you agree to rent out your shares, the cash is deposited into your brokerage account. You can use that money for whatever you want. Reinvest it, pay some bills, or maybe even smash that like button for the YouTube algorithm. This isn't some far-off promise of future profits. It's tangible cash you receive today. This process turns your otherwise lazy, passive stocks into active, income-generating assets. It's a way to put your money to work in a way that most people have never even heard of, giving you a serious edge in building your wealth over the long run. So, if you're someone who has at least 100 shares of a single stock, you're sitting on a potential goldmine of passive income. You've already done the hard part, which is saving up and investing in the first place. Now it's time to take it to the next level and optimize your portfolio to its fullest potential. This isn't about taking on massive risks, it's about being smart and efficient with the assets you already control. Okay, so I keep using this term, renting out your stocks. Let's break down what that actually means in the simplest way possible. When you own a stock, you own a tiny piece of a company. Normally, you make money in two ways. The stock price goes up, appreciation. Dividends, the company pays you a little bonus. But there's a third way. You can give someone else the option to buy your stocks later at a specific price. In exchange for that option, they pay you a fee right now. That fee is your rent. It's your money to keep, no matter what happens next. Think of it like this. Imagine you own a house and you're happy with it. Someone says, I might want to buy your house in a month for $500,000. I'm not sure yet, but I want the exclusive right to do so. You say, to lock that right, you pay a non-refundable $2,000 now. They agree and pay the $2,000. Show diagram, owner hands key, buyer gives bag of money. Now you keep the $2,000 whether they buy or not. You've been paid for selling an opportunity, not the house. That's exactly what happens with your stocks on a smaller scale. The process is built around an options contract. It sounds complicated, but an option is just a contract. It gives someone the right, but not the obligation, to buy a stock at a set price by a certain date. It can also give the right to sell a stock at a set price by a certain date. When you rent out your shares, you're selling one of these contracts to another investor. That investor is usually betting the stock will shoot way up and wants to lock in a purchase price now. You get paid for taking the other side of that bet. You're basically saying, I'm willing to sell at this higher price, and they pay me for that privilege. The key thing? You are in control. You decide the strike price. You decide the time frame, expiration. This isn't a random person at your door. You're listing this opportunity on the market through your brokerage. You are the landlord of your stocks, setting terms and collecting rent. They get a choice. You get cash. Often you keep both the cash and the stocks, letting you run this play again and again. Now that we understand the concept of renting out stocks, let's give this strategy its official name, the covered call. Don't let the name intimidate you. It's called a call because you're selling a call option, which is the right to buy a stock. and it's covered because you actually own the underlying stock. You have the shares to cover the deal if the buyer decides to exercise their option. This is what makes the strategy relatively safe compared to other options trading methods. You're not promising to sell something you don't have. You're just agreeing to sell something you already own. So here's the deal in a nutshell. A covered call involves two simple things. First, you need to own at least 100 shares of a stock. Options contracts are traded in bundles of 100, so this is the minimum requirement. Second, you sell a call option against those 100 shares. By doing this, you are agreeing to sell your 100 shares at a predetermined price called the strike price on or before a specific date, the expiration date. In return for making this agreement, you receive an instant cash payment which is known as the premium. That premium is yours to keep, forever. Let's think about why someone would buy this option from you. The buyer is typically an optimist. The buyer is typically a speculator. They believe the stock price is going to rise significantly, and they want to lock in a purchase price now. By buying the call option from you, they get the chance to buy the stock at the strike price, even if the market price soars way above it. They are paying you the premium for this opportunity. You, as the seller, are essentially saying, "I'm happy with the stock. But if the price goes up to this specific level, I'm comfortable selling it and taking my profits." You're being paid for your willingness to part with your shares at a price you choose. The covered call strategy is most popular among long-term investors who own stocks they believe in, but don't think will experience explosive, meteoric growth in the short term. It's perfect for those slightly boring, stable blue-chip stocks in your portfolio. By selling covered calls, you can generate a steady stream of extra income from these holdings, effectively lowering your cost basis over time and boosting your overall returns. It's a conservative strategy designed not to hit a home run, but to consistently get on base and score runs month after month. It's the financial equivalent of a slow and steady grind that adds up significantly over time. All right, let's get tactical. You're ready to collect your first rent payment. How do you actually do this? It's much easier than you think. Most modern brokerage platforms like Fidelity, Charles Schwab, Robinhood. First things first, you need to get approved for options trading. Fill out a short digital form answering a few questions. For selling covered calls, you typically only need level 1 or level 2. That's the most basic. You'll likely be approved within a day or two. Once approved, identify the right stock in your portfolio. Golden rule: own at least 100 shares. Theory is great, but let's see how this works with some actual numbers. Let's invent a company. Coffee Corp, ticker CFE. Imagine you're a long-term believer in coffee and you own 100 shares of CFE. Today is September 9th, 2025, and the stock trades at exactly $50 per share. Your total investment is worth $5,000. That's 100 shares times $50. You think the stock is solid, but you don't expect it to jump to 70 next month. You want to generate extra income from these shares. So you open your brokerage and pull up the options chain for CFE. You decide to sell a covered call that expires in about a month, October 17th, 2025. You scan the available strike prices. You pick the $55 strike. If CFE hits 55, you'd be happy to sell for a $5 per share gain. The premium for that $55 call is $1 per share. One options contract controls 100 shares. Selling one contract instantly deposits $100 into your account. Now fast forward to expiration. October 17th. One of two things will happen. Scenario A, CFE stays below $55. Say it's trading at $54. The option is worthless. The buyer wouldn't exercise at $55 when the market is $54. The option expires. You keep your 100 shares. You also keep the $100 premium. Then you can sell another covered call next month and collect another premium. Scenario B, CFE rises above $55. Say it's at $57. The buyer exercises their option to buy at $55. Your broker handles the sale. You sell 100 shares at $55 each, $5,500 total. Stock profit, $5,500 minus your $5,000. Cost equal, sign $500. Plus you keep the $100 premium. Total profit that month, $600. Downside, You no longer own the stock, but you sold at a price you were happy with and made a great return. Final advice: start small and learn the ropes. Don't sell covered calls on your entire portfolio tomorrow. Pick one stock you own 100 shares of that you wouldn't mind selling. Sell one contract a month or two out with a strike comfortably above the current price. Collect that first small premium. Watch how it works. See how you feel as expiration gets closer. Hands-on experience with minimal risk is the best education. If you like it, slowly scale up.